Hello, everybody. Welcome to today's episode of the Daily Dose. Today is September 23rd, Friday. And we saw the stock market continue to sell off today. There's a lot of panic in the markets right now. We are currently revisiting the lows from June. People are starting to freak out, saying that the Fed has done too much, but I'm here to say that the market is doing exactly what it should be doing. In a market where we had stimulus and money printing and 0% interest rates, valuations got out of control. We didn't see any real corrections in the market. And now that the economic situation has turned for the worst, geopolitically has turned for the worst, and at a monetary standpoint, the Fed is tightening at rates we've never seen before. This is exactly what the market should be doing. The stock market should be doing in this situation. It's really nothing that couldn't have been foreseen. And it's in a good spot if you're a long-term investor. It's a great time to invest, to get assets you like at good prices. And it will continue to be as long as the Fed stays hawkish and the market keeps going down. It'll be a great time to invest. So what happened today? Actually, first, before I do that, I just want to say, if you like this type of content, please be sure to subscribe here on YouTube and follow us wherever you listen to podcasts. It would mean a lot and help us support the channel. But let's get into it for today. So the S&P 500 was down 1.72%. The NASDAQ was down 1.8%. The Dow was down 1.6%. So U.S. stocks spiraled to cap a volatile week lower Friday as fears that aggressive central bank tightening would trigger a recession wreaked havoc on financial markets. And I would argue that we are already in a recession and have been in a recession since we got that news that we had a second consecutive quarter of real GDP decrease. The VIX was up today. I don't know I think it had it up here somewhere. There it is. There's the VIX. The VIX was up 9.5% today. So I'm still looking for that to get to at least 45.50 before I think we're at like a bottom point. If we look at the markets year to date, the NASDAQ's now down over 30%. The Dow's approaching 20%. You see the S&P's down 22.5%. So these moves come after the Federal Reserve officials raised interest rates by 75 basis points for a third straight time, and that was on Wednesday. The Fed Chair Jerome Powell implied that in his hawkish remarks that policymakers were prepared to accept economic pain in exchange for restoring price stability. And you know what really sucks about that is the people that are getting hurt the most from trying to reduce inflation are not the people who caused inflation. Generally speaking, this is your working class, your middle class, lower class. These are the people struggling from inflation that was caused not because of something that they did, and now they're going to be the ones to lose their jobs and struggle even more because now the Fed has to get inflation under control. So it's just a messed up situation. These types of environments really increase the wealth gap between the upper class and the middle class and the lower class. And really the only way to keep up with any of it is to invest for the long term and get good assets at good prices, whether you're buying a commodity, a business, a real estate, something else. Get a good asset at a good price and don't sell it. And that's the only way you can keep up. Other than that, you're just going to get hit hard by these policies. So Goldman Sachs slashed its year-end 2022 target for the S&P 500 index from 4,300 to 3,600. And I just think it's funny because it seems like senior in high school is in charge of their price targets. When the S&P 500 was at like 4,100, they made their price target 4,300, and then the S&P fell to, what is it, at like 3670, and they're like, it's going to finish at 3600. So I just think that's funny. They're basically just following the market like everybody else is. No one knows what's going to happen to the stock market, not even Goldman Sachs. So that's apparent from these targets that they've released and the timing of them. So the expected path of interest rates is now higher than we previously assumed, with tilts the distribution of equity outcomes below our prior forecast. So that was from Goldman Sachs as well. Based on our current client discussions, a majority of equity investors have adopted the view that a hard landing scenario is inevitable, and their focus is on timing, magnitude, and duration of a potential recession and investment strategies for that outlook. So, I mean, honestly, I think that if you're looking for a bottom to be close, this is what you want to start seeing. You want to start seeing panic. You want to start seeing big institutions like Goldman Sachs saying that the sky is falling. That's when you'll really see a bottom. What you'd look for to happen next is the VIX to spike more than it has so far. You need the VIX to spike to like 45 or 50 along with this type of sentiment. So now we're starting to get this sentiment that the S&P 500 is doomed, that stocks are doomed, and that's really what you want to see if you're a long-term investor. I know it sounds backwards, but that's what you want to see. So let's take a look at the S&P 500. I'm going to do this before I forget today. Let's get the 200-day moving average. So after the VIX spikes, so let's say that the VIX spikes and we still have this sentiment in the markets that the sky is falling. Institutions are bearish. Retail investors are bearish. Then what would you look for? So let's say that happens. Let's say we break through these lows. The VIX spikes and we hit this channel line. Let's say unemployment starts spiking and we're here. We're somewhere along this channel line. We're below the June lows. We're sitting down here somewhere. That's when I would start to expect a bottom in the market. Somewhere down here when no one thinks that we can go bullish. And then what should you expect? You'll start to get the movements higher. They'll say it's a bear market rally, which maybe it will be, but maybe not. So in that stage, what would you be looking for? I would be looking for the market to break through this trend line that's been respected 3 times, and it's really goes through literally the top day in the market, and it comes through this whole entire market. That trend line needs to break and get closed through, and this 200-day moving average needs to get broken through. And whatever order it happens in, once they're both broken through and closed above and we're still in the bullish trend, you'll know that we've seen the bottom. But since you won't know that until after it's recovered, your best option is to keep investing while the prices are getting hammered like this. You only get this type of opportunity every couple of years, and you can't let it go by. You can't get scared out of your positions. You can't sell out. You can't just go to cash. This is where you make money. This is how you keep up with the wealth inequalities that we have in the world. You have to keep up somehow. So we touched the bottom. We basically touched where we were in the June lows today and bought back from there. But nothing about this market is looking bullish at all. Obviously, we could get some buying pressure now that we're at the bottom of this zone. But if we break through here, it could either be capitulation to the channel line, or it could be move down sharply to this zone, some support. Maybe we try and come back up. We touch the June lows from the up or from the bottom. And then we go to the channel line somewhere down here. But you can't let what Goldman Sachs or Yahoo Finance or anybody, you can't let them sway your decisions, because when sentiment is the lowest, that's when you're getting the best value, and your future expected returns are actually going up as the market goes down if you're investing. So stay vigilant. That's all I can say. Bitcoin, same story, sold off today. Not as much as the stock markets, or about the same amount, but it's been in this range forever now. We talk about it every day. I know. The 17.5 to the 17.7 is our critical support for Bitcoin. I think it's going to get interesting if it doesn't break one way or another before it gets to this trend line, because I think it's going to have to react to this trend line somehow, and most likely to the downside, especially if we're seeing some severe selling in the stock market as well. Again, there's no support really on Bitcoin until 9 to 12,000. So anywhere between 9 and 12,000 would be a great price for a great asset. So I know that's a place where I would be investing in Bitcoin for sure. I have some cash built up that I want to invest, but I don't plan on doing that until one of two things happen. Either we get the 9 to 12,000 level on Bitcoin, or the Fed pivots and starts getting less hawkish and starts easing. In any of those two scenarios, I would then allocate the cash that I've been saving to invest in this, and I'll allocate that to Bitcoin. There's just so much upside here. Obviously, we have the halving coming up in 2024 for Bitcoin, and that'll contribute to the price as well. But that's really all I have today. I thank you for listening. Again, if you want to hear more about what I was talking about with the sentiment, I released a weekly wrap episode a while ago, and the title is Retail Sentiment Needs to Die, or Market Sentiment Needs to Die. That'd be a great episode if you're trying to learn more about kind of what I was talking about today. And then honestly, I would recommend this past weekend's episode, History Doesn't Repeat, It Rhymes. That was a great episode comparing this market to previous bear markets and capitulation events. Again, if you like this type of content, we put out a video like this every single day, so be sure to subscribe on YouTube and follow us wherever you listen to podcasts, and make sure you stay tuned for the weekend episodes as well. They're a little bit longer. They go more in depth and just have a little bit more analysis on them. But until then, thanks for watching or listening to this episode, and I'll see you in the next one.